Hey everybody, back with another dividend analysis, and today we're going to be looking at Best Buy Company, or BBY. Everybody knows Best Buy, electronics retailer. Interesting to look at today. They're having a bit of a slump after a pretty good run-up over the last year and year to date, so we're going to take a peek at them, see if it's something to look at, something to buy. As always, we'll start with our dividend yield, and currently we're sitting at just under 2.5%, so not a very large dividend, a little bit better than the wide market. Pretty standard yield range for a retailer, so nothing amazing there, but let's see what's going on. If we go back through our dividend history, we can see that since 2013 we have gone from 17 cents a share up to 70 cents a share. There is one little blip in here where it goes from 23 to 73 to 28. That's, I'm assuming, a special dividend that they paid out, so that doesn't count as any dividend cut going from 73 to 28. So we can see a lot of good growth here, especially over the last year. We got a nice 15-cent increase on our dividend. It's a little over 25% increase, very nice, and been growing very nicely over the last 8 years. We've, quadrupled plus our dividend in that time. Very nice, a lot of growth there, good to see if you're a dividend growth investor. Next, let's go look at the numbers. We can see that last year they paid out $602 million in dividends, so we'll be able to check our ratios according to that. And let's go over to our cash flow. We'll check the last 4 quarters, and we can see that in the last 4 quarters they did $3.5 billion in dividends. If we do our ratio there, we can see that they're only using about 17% of their free cash flow to pay out dividends. That's incredibly low, actually. If I'm a dividend investor, I'd like to see that a little bit higher. I'd like to be getting a little bit more of my money in the form of dividends, but it's very understandable. They're probably using the remaining 83% of that cash flow to do other things like buy back shares, make some acquisitions, do some other things. But again, 17%, well below our ideal range of 50%. They could double or triple this dividend and still have plenty of money left over to pay it. So this is a relatively safe dividend. They would have to Their cash flow, their income would likely have to plummet by orders of magnitude for this to be in danger of in any way. Those dividend increases likely to continue if this free cash flow increases. The one thing I will say is that they did have a really big drop off over the last 10 years. They went from 2.5 to the negatives, back to stabilizing around 1.5 billion. Then the last 2 years, with 2020 being an anomaly, they've had a really big rise because a lot of people have been buying electronics to work from home and a few other reasons, so keep that in mind when you're looking at trends over the future. Next, let's go over to our income. Again, we'll use the last 4 quarters. Looking at our income, we can see that there's really been a big increase over the last 10 years, let alone the last 5 years. Went from losses in 2012 to almost a loss in 2013 to now being over $2 billion in income. A lot of growth there, very nice. When we check our ratio, we can see they're doing about 27% of their income is being paid out as dividends. Again, very low, well below our ideal range. They could double the dividend and they'd still barely be above the ideal range. They're making plenty of money to be able to afford that dividend. Dividend increases, again, very likely to continue if this trend of increasing income continues. So where do they get their money from? How are they creating this income? How are they creating this cash flow? Everybody, again, knows Best Buy selling electronics, computers, home entertainment, phones, Apple products, so on and so forth. Not as niche of a market as they used to have, whereas 15 years ago when people thought electronics, they thought Best Buy. They do have a lot of competition nowadays. That's something you really want to look at when you're looking at this company. Their competitors are things like Walmart, things like Target, a lot of online retailers like Newegg, for example. They have tons of competitors out there. A lot of the old ones that they used to have, like Circuit City, don't exist anymore, but they have new competitors in other forms. So if I'm looking at this company, one thing I want to look at is their market share among the retail sales for certain items. Look at that, see how well they're doing. Is that market share increasing? Is it decreasing? Is their income going to be going up more than just, acquisitions, inflation, GDP? You really want to check those kind of things when you're looking at this kind of retailer. See how they're doing in their sector. Are they doing better than their competitors? Things like that. Now, when it comes to who should be buying this, is this something you should be looking at? This is definitely a dividend growth stock as opposed to an income stock. At 2.5%, this would be this would be very close to the bare minimum for an income stock, maybe even below that. If I'm an income investor, I'm probably going to pass on this. There's just not a lot of income potential here. That yield isn't going to be getting much higher than it is. 3% is probably going to be 3 to 4% might be the maximum of where you're going to see it, which is fine. There's nothing wrong with that. If you're an income investor, this is definitely on the lower end of your radar. However, if you're a dividend growth investor, as we go back and look at their dividend growth, it's been very solid over the last 8 years. If the trends continue with working at home and people getting more and more electronics, things like that, there's definitely going to be a lot of room for dividend growth here. I know that they are held by a lot of dividend growth ETFs, so even if that stock price of $100 is prohibitive for you, there are plenty of ETFs that are going to hold this, or you could just buy it by itself. If you're a dividend growth investor, you're probably going to get a lot of value here. Aside from that, that's probably all you're really looking at this for, is dividend growth. Again, the income's not amazing. Value-wise, it's probably priced right around where it's supposed to be. So if you're a dividend growth investor, this is definitely this is the kind of company you're going to want to be looking at. Just go and look at those things that I mentioned. Make sure that the numbers, the market share, the competitors, things like that all work out to a place where you find this company to be something you want. And I don't think you'll go wrong if all of that works out for you. I hope that helps, and thanks for watching.